This is Terrence Andre Banks with Information Age Financial Solutions coming to you with an article I read from ProjectSyndicate.org. Not a website that I visit often, but I saw this article just caught my attention, a Greater Depression. And with everything going on, and Nouriel Roubini is actually pretty known in the space for different economic issues. So that's why I would draw my attention, of course, the Greater Depression. It's because we're hoping to get back to normal, but before, they were hoping it was just going to be a mild recession, everything was going on financially. But what he points out in this article is quite fascinating. We'll dive right in. As always, I'll put a link inside the description. With the COVID-19 pandemic still spiraling out of control, the best economic output that anyone can hope for is a recession deeper than the 2008 financial crisis. But given the flailing policy response so far, the chances of a far worse outcome are increasing by the day. New York, the shock to the global economy from COVID-19 has been a little faster, and even the Great Depression. In those two previous episodes, stock markets collapsed by 50% or more. Credit markets froze up. Massive bankruptcies followed. Unemployment rates soared above 10%, and GDP contracted at an annualized rate of 10% or more. But all of this took around 3 years to play out. In the current crisis, similar dire macroeconomic and financial outcomes have materialized in 3 weeks. That's what makes it so different this particular time. Early this month, it took just 15 days for the U.S. stock market to plummet to bear territory, a 20% decline from its peak, the fastest such decline ever. Now markets are down 35%, credit markets have seized up, and credit spreads like those for junk bonds have spiked to 2008 levels. Even mainstream financial firms such as Goldman Sachs, JP Morgan, and Morgan Stanley expect U.S. GDP to fall by an annualized rate of 6% in the first quarter, and by 24% to 30% in the second. The U.S. Treasury Secretary Steve Mnuchin has warned that the unemployment rate could skyrocket to above 20%, twice the peak level during the GFC, the Great Financial Crisis. In other words, every component of aggregate demand, consumption, capital spending, exports is in an unprecedented freefall. While most self-serving commentators have been anticipating a V-shaped downturn, which means that if you look at the V, it's going to go down and a steep drop and then go right back up. With output falling sharply for one quarter and then rapidly recovering the next, it should now be clear that COVID-19 crisis is something else entirely. The contraction that is now underway looks to be neither V, nor U, nor L-shaped. A sharp downturn followed by stagnation rather looks like an I, a vertical line representing financial markets and the real economy plummeting. Not even during the Great Depression of World War II did the bulk of economic activity literally shut down, as it has in China, the United States, and Europe today. As we're global, and this is effect globally, that's what also is pushing to be even a greater depression than we've ever seen before. The best case scenario would be a downturn that is more severe than the financial crisis in terms of reduced cumulative global output, but short-lived, allowing for return to positive growth for the fourth quarter of this year. In that case, markets would start to recover when the light at the end of the tunnel appears. But the best case scenario assumes several conditions. First, the US and Europe and other heavily affected economies will need to roll out widespread COVID-19 testing, tracing and treatment measures, enforced quarantines, and a full-scale lockdown of the type that China has implemented. And because it could take 18 months for a vaccine to be developed and produced at scale, antivirals and other therapeutics will need to be deployed on a massive scale. Second, monetary policymakers who have already done in less than a month what took them 3 years to do after the GFC must continue to throw the kitchen sink of unconventional measures at the crisis. That means zero negative interest rates, enhanced forward guidance, quantitative easing, which is money printing, and credit easing, the purchase of private assets to backstop banks, non-banks, money market funds, and even large corporations, commercial paper and corporate bond facilities. The U.S. Federal Reserve has expanded its cross-border swap lines to address the massive dollar liquidity shortage in global markets, but we now need more facilities to encourage banks to lend illiquid but still solvent small and medium-sized enterprises. Third, governments need to deploy massive fiscal stimulus, including through helicopter drops of direct cash disbursements to households, which they're already signed into law, looks like. Given the size of the economic shock, fiscal deficits in advanced economies will need to increase from 2 to 3% of GDP to around 10% or more. Only central governments have balance sheets large and strong enough to prevent that private sector's collapse. But these deficit finance interventions must be fully monetized. If they are financed through standard government debt, interest rates would rise sharply and the recovery would be smothered in its cradle. Given the circumstances, interventions long proposed by leftists of the modern monetary theory school, including helicopter drops, have become mainstream. Unfortunately, for the best case scenario, the public health response to advanced economies has fallen far short of what is needed to contain the pandemic, and the fiscal policy package currently being debated is neither large nor rapid enough to create the conditions for a timely recovery. As such, the risk of a new giant depression, worse than the original, a greater depression, is rising by the day. Unless the pandemic is stopped, economies and markets around the world will continue their free fall. But even if the pandemic is more or less contained, overall growth still might not return by the end of 2020. After all, by then, another virus season is very likely to start with new mutations, therapeutic interventions that many are counting on may turn out to be less effective than hoped. So economies will contract again and markets will crash again. Moreover, the fiscal response could hit a wall if the monetization of massive deficits start to produce high inflation, especially if a series of virus-related negative supply shocks produce potential growth. And many countries simply cannot undertake such borrowing in their own currency. Who will bail out governments, corporations, banks, and households in emerging markets? Good question. In any case, even if the pandemic and economic fallout were brought under control, the global economy could still be subject to a number of white swan tail risks. While the U.S. presidential election approaching the COVID-19 crisis will give way to renewed conflicts between the West and at least 4 revisionist powers, China, Russia, Iran, and North Korea, all of which are already using asymmetric cyber warfare to undermine the U.S. from within. The inevitable cyber attacks on the U.S. election process may lead to a contested final result, with charges of rigging and the possibility of outright violence and civil disorder. He covers everything in this article. Similarly, as I have argued previously, markets are vastly underestimating the risk of war between the U.S. and Iran this year. The deterioration of Sino-American relations is accelerating, as each side blames the other for the scale of the COVID-19 pandemic. The current crisis is likely to accelerate the ongoing balkanization and unraveling of the global economy in the months and years ahead. The trifecta of risks on contained pandemics, insufficient economic policy arsenals, and geopolitical white swans will be enough to tip the global economy to persistent depression and a runaway financial market meltdown. After the 2008 crash, a forceful, though delayed, response pulled the global economy back from the abyss. We may not be so lucky this time. Wow. Though it's a lot of doom and gloom, he covers and makes his argument pretty effective. I encourage you to take a look at this. It's really interesting, and I kind of read through it quickly. We live in unprecedented times now. We need to do everything differently and think things differently as a whole. If this video has been any value to you, please subscribe, leave some comments, and to my next video, I'm out.